guys, welcome back to Ride On Academia. We are still on our series on the final account of a sole trader. Alright, we've dropped videos on the trading accounts, the profit and loss accounts. We've dropped videos on the statement of financial position, which we call our balance sheet, right? And then we have been able to look at the theoretical aspect of adjustments and provisions. So today we are going to be looking at the practical treatment of adjustments. Now, it's very important that if you've not watched the theory aspect, you please do so before watching this particular video for better understanding. Okay, so quickly in this video, what we are going to be doing is we'll be taking a question and then we'll be applying the many principles that we have discussed in the theoretical aspect. Okay, now there's a question before us and then we'll be solving it quickly. All right, so as you can see before us is a trial balance that was given. Okay, and then we have certain additional information attached. These are the adjustments, right, to be made. As you can see, we have additional informations where we have to make adjustments, right? So what we are going to be doing is we are going to be treating the adjustment first, and then we'll be preparing the comprehensive income statement and the statement of financial position. All right, welcome back. So what we are going to be doing now is we are going to be making it adjustments. Okay, using our additional information, I'll be taking them one after the other and then we'll be seeing how to treat them. Like I said, adjustments must be treated in both the comprehensive income, right, and then the statement of financial position. So we'll be taking them one after the other and then we'll be seeing how to treat them in the comprehensive income statement and in the statement of financial position. Now we are giving the inventory. Okay, like I said that our closing stock always appears outside the trial balance. Okay, it does not appear inside. So when we see inventory or we see closing stock, once it is outside, it refers to closing stock. Okay, now we have inventory as at 31st December 2016 to be valued at 152,460. all right, so the first information is on our closing stock. Okay, so our closing stock is 152,460. okay, this is our closing stock. So we'll be lessening this, right, like we said in our theoretical aspect, that will be lessing closing stock from our cost of goods available for sale, right, and then we'll be treating it as a current asset when we get to the statement of financial position. Okay, now we're going to be going to the next one. We have rate outstanding, and that was for owing. Okay, when we are owing, we call it outstanding. Okay, it means that the rate was not paid, that amount was not yet paid. Okay, although that rate was enjoyed that year, it has not yet been paid. Okay, so we call them the accruals. That's the accrued expenses, unpaid expenses. Okay, so like I said in our theory, we're going to be adding the unpaid, okay, to the one that was paid in the trial balance to get our total expenses for the year. All right, so our rate for the year as given in our trial balance, our rate for the year is 20,550. Let's write the information quickly. We have our rate outstanding. Like that, this is the unpaid, and we have it to be equal to 3,110 naira. Okay, this is our rate outstanding. Let me bring in my naira sign so that we can follow, right? We are through with this, and this is our rate outstanding for this. So this is a liability on the business, right? So when we get to our statement of financial position, we'll be taking this as a liability, okay, in our balance sheet. Meanwhile, in our comprehensive income, we try to look at all the expenses for the year. Okay, this is just the unpaid expenses. So we're going to be looking at the expenses that was actually paid, the rate portion that was paid for, and that rate portion that was paid is 20,550. So to give us the total rate for the year, right, we'll be having this. So this is our total rate for the year, and this is what will be going to our comprehensive income. All right, what we get to our comprehensive income is the expenses that was actually enjoyed in the year. Okay, so this expense was enjoyed in the year, but only a portion of it was paid. That's why it's reflected in the trial balance. All right, now the next we are having is insurance prepaid. Now no longer outstanding, prepaid. Okay, it was paid ahead of into the next year, right? It was paid ahead of the year. So we are going to be treating prepayment as an income for a business, a current asset. All right, we'll be treating it as a current asset in our statement of financial position. So let's get to insurance prepaid. That's our third. So this will be going to the balance sheet as a current asset, right? Prepayment. Now we have to less, since it was prepaid, means if this amount was paid into the next year. But in our comprehensive income, we want to just look at expenses for this year, okay? Income for this year, expenses for this year, alright? So we're going to be deducting the money for next year from the money we have paid. Are we there now? So insurance, the total insurance paid as given in the trial balance, we have insurance to be equal to 24,050 naira. Okay, this was the total amount that was paid as given in the trial balance. So if we want to know, this amount was paid, right? The total amount paid, but 630 naira in this amount was for next year, all right? So if we want to know the amount that was paid for this year or the amount that was enjoyed this year, we have to remove the money of next year from this, right? So we're going to be lessing, and like I said in account, when we less, we bring in our bracket, all right? So when we less, we'll be having this, okay? So this is the amount we'll be treating in our comprehensive income statement, all right? Now the next one we have is lighting expenses in arrears. In arrears, another word for arrears is still accruals. They are still accrued expenses. That means we are still owing. We have enjoyed them, but we are yet to pay, okay? Lighting expenses in arrears for the fourth. So we have that amount to be 1,670, I think. 1,670, okay? That means we are owing this amount, okay? We have enjoyed, but we are yet to pay. It's still the same thing as owing, like I said, right? So we are going to be adding it the same way we treated this, right? We are going to be adding it to the amount we paid in the trial balance. So our lighting expenses in the trial balance is 8,590 naira. Right? When we add, this will be going to our balance sheet like we did. Okay? The owing part is going as a current liability. So we'll be adding this. We have. So this is what we'll be treating in our comprehensive income, right? Yes. We have our next additional information that a bad debt written off amounted to 1,000 naira, alright? Now I said when bad debt comes in the additional information, right, then we'll be treating it in two places like we always do. It means it's an expenses on the income for that year, for this current year, right? It's an expenses on the income as well as a reduction in the value of debtors. Are we there now? So a bad debt written off we have 1,000 naira, okay, as a bad debt written off for the year. Now if you look at the trial balance critically, we also have that there was a bad debt in the trial balance, okay? That means that bad debt was written off last year, all right? And then it was carried forward. If we have bad debt in the trial balance, it means it was from the last year. So we just treat it as an expense for the year, okay? So we are having double bad debt now to be treated as an expense. So we're going to be adding the total bad debt together, all right? But this bad debt, the one in the additional information, will be reducing from the value of debtors, all right? So our total bad debt for the year, increase in bad debt, will be adding the bad debt from the trial balance. We'll be bringing it forward from our trial balance. We're having a bad debt of 200 naira. So it means when we prepare our comprehensive income statement, our bad debt value, all right, for the year will be the arrears plus the current year, right? Then, like I said, since this one came in the additional information, it will also be reducing the value of debtors. So quickly, because of this, we are going to be considering the value of debtors, okay? So we'll be checking the debtors value, and then we'll be reducing 1,000 naira. Alright, so from our trial balance, our debtors is our receivables, okay? The same thing. So our trade receivables in our trial balance, we have 201,600 naira. And then because of this bad debt that was written off, okay, we'll be lessing 1,000 naira. Alright, so our new debtors value when we get to our balance sheet, okay, will be 200,600 because of this bad debt was written off. Alright, now let's go to our next workings. We have that provision for bad debt. Now, like I said, provision for bad debt is actually different from bad debt, okay? Provision for bad debt should be 2% of trade receivables. Trade receivables are debtors, right? And now, because we have made this adjustment, we'll be using 2% of this, alright? So provision for bad debt should be 2%. This is our fifth workings. We have that provision for bad debt to be 2%, right? 2% of our trade receivable, that's our debtors, right? This is 200,600 naira. Okay, so the 2% of this will be having to be 4. Okay, so this is our 2%, right, of our provision for bad debt, our new provision. We are asked to be using this instead of the provision we have, because if you look at the trial balance, we are giving a provision from the last year, okay? So we are adjusting that provision this year to be this, okay? So like I said, we are going to be comparing those two provisions, whether it is an increase or a decrease. That's why I said if you've not watched our videos, you need to in order to be able to follow what we are doing, okay? Now, in the provision we have in the trial balance, the provision we have, we are giving a provision for bad debt of 800 naira. All right, we're giving a provision. Okay, so we have a provision for bad debt, like we calculated to be 4,012, right? We're going to be comparing with our previous provision. Our previous provision for bad debt. Now that will be given in the trial balance, okay? Now our previous provision as given in the trial balance is 800 naira. As you can see, this is an increase, right? The current provision is higher than the previous. So we are going to be checking the increase, okay, by lessing. We are going to be subtracting, right? So our increase in provision, when we subtract, we'll be having 1,212. Alright, so when we less this is our increase, okay? We'll be treating this as an expenses in the comprehensive income statement, whereas this will be the new provision we'll be using. All right, now the next information we have to adjust for, we are adjusting for the provision for depreciation, okay? Provision for depreciation, like I said, when provision for depreciation comes in the additional information, we treat it as the annual depreciation, okay? So provision for depreciation is given, and then we have, they said for motor vehicle it should be the rate of 5%. So for motor vehicle, depreciation is 5%, okay, of course. We have 5% times the cost, so we need to go to the trial balance and check for the motor vehicle cost, right? And our cost is given to be 258,750. This is our current depreciation for the year, right? Our annual depreciation. So when we do 5% of that, we're going to be having 12,937. Okay, we'll be having 12,937.5. okay, so to the nearest whole number we'll be having 38. All right, now this is our annual depreciation. for the we're treating as an expenses, right, in our comprehensive income. Now when we get to our balance sheet, we'll be looking at accumulated depreciation, right? So I will be adding our annual depreciation to the provision given in our trial balance, okay, to get our accumulated depreciation. So our accumulated depreciation will be this, and then the provision in our trial balance is 2,000 naira. That is for motor vehicle. We have 2,000 naira. So when we get to accumulated, right, we'll be having this plus 2,000 naira, okay, and that will be giving us 14,938. This is what we're going to be taking to our balance sheet, okay. We'll be lessing this from the cost of the motor vehicle, whereas this will be in the comprehensive income as an expense on profit for the year. All right, now the next provision we have is for, we are told that furniture and fitting, we should depreciate furniture and fitting at the rate of 10% on its book value, okay. We are asked to depreciate furniture and fitting at the rate of 10% on its book value, right, not on cost. Now we depreciated motor vehicle on cost. We have to depreciate furniture and fitting 10% on its book value. How do we get the book value? We less the previous accumulated depreciation from the cost, all right. Now from our information given in the trial balance, the cost of our furniture and fitting is 111,000. This is the cost. 111,240. This is our cost, right? And then the book value they told us, okay. So we have an accumulated depreciation also in our equation for furniture and fittings to be 3,000 naira. All right. So we're going to be lessing this to get our book value, okay. So when we are going to be lessing this amount to get our book value of 108,240. Okay. So this is what we are going to be using to calculate. This is our book value. This is what we're going to be using to calculate for our annual depreciation, all right. And then they ask us to take for annual depreciation 10%, okay, or times the book value, not the cost, okay, times this is our book value. So 10% times our book value, 108,240. We're going to be having 10,824 naira. So this is our format, all right. And then the next one we have, the next information that we have to provide for discount allowable on 1% of trade receivables, okay. We also have to make a provision for discount allowable. I think that's the last one we have, all right. We have to make a provision for discount allowable for 1% on trade receivables. Now this is our trade receivable. I think we have done adjustment on that, all right. And then we have provided for bad debt, right. So to get our new amount, now this is our new provision. So before we do any other adjustments, we must adjust our debtors value again, okay. Since we have bad debt, it's going to be affecting the debtors value. So we are going to be reducing, to get our new value, we are going to be reducing 4,012 from this, okay. So when we reduce 4,012, what we are going to be having is 196,588. So this is the amount we are going to be using now. Like we have reduced, okay, our new provision for bad debt, right, to get this amount. So this is where we are going to be getting our discount allowable. We are asked to make provision we are going to be using 1%, okay, 1% of this amount, right, 196,588. So that will be giving us approximately 1,966, okay. I think to the nearest whole number. This is going to be our provision for discount allowable, right? So that when we get to the balance sheet, we'll be using this amount. Then for our new debtors value, we'll still be lessing this, all right. We'll still be lessing the provision for discount allowable. So we've come to the end of our workings. We'll be using these workings to prepare our comprehensive income statement as well as our statement of financial position. So please stay with us. Thank you. All right, welcome back. As you can see, we have solved, okay, we have prepared our statement of comprehensive income, as you can see, right. Now the first thing we always do is the name of the owner of this account. As you can see, Mr. Ikechukwu and Sons Enterprise, and then we're able to address our account. Like I said, we always address it as statement of comprehensive income for the year ended, okay? And then we have our dates right there, and then our currency sign. I'm in Nigeria, so you can use your own currency sign, okay? Now we follow the format. We have our sales, okay? Now our comprehensive income, like I said, we are combining the trading account and the profit and loss account, right? So we have our trading section where we have our sales, we less our sales returns or returns inward to get our net sales. Then our opening stock, as you can see, we got to our gross profit, right? And then where we got to make adjustments. Now we made this provision for adjustment. We have in the insurance, like we just did on the workings, right? Where we are going to remove our prepayment, right, to get the total insurance for the year. And then we also have the increase in our bad debt. We treat increase in bad debt as an expense, right? All those adjustments are reflected in the profit and loss section of our statement of comprehensive income. Every other section, the trading section is always okay, all right? The adjustment we have mostly comes in our profit and loss section. So we have the increase in our provision for bad debt as an expense here. We have our lighting expenses where we had to add our accruals, right, to get the amount for lighting for the year. All right, we have also we have the bad debt, right, from the trial balance. This was the bad debt given, and then we have an additional bad debt in our additional information. So our bad debt will increase for the year to 1,200, right? And then we also have outstanding, okay? We have rates. Our rate was 20,550 naira that was recorded in the trial balance. That was the money paid, okay? The trial balance only recorded the amount that was paid, but other rates were enjoyed which was not yet paid for, right? Which is the outstanding rate of 3,110 naira. So for the year, we enjoyed a total rate of 23,660 naira, right? So we're going to be adding our outstanding to our rate value to get this. And then our depreciation, like we did, the first depreciation was on cost of motor vehicle, right? But the next was on the net book value on furniture and fittings. All right, so this was the depreciation. We got 10%, 5%, and then lastly we made a provision on discount allowables. Now all these provisions will be affecting the value of trade receivables, right? We'll be seeing that in our next video. Anyway, we'll be seeing that in our next video when we get to the profit, the statement of financial position. All right, so we made a provision for discount allowable to be 1%, right, of our trade receivables, and then we have this. Now when we sum up all these expenses, other people like to categorize anyway, but we were not given information to categorize this particular expenses. That's why I did not categorize, okay? So when we sum up all our expenses, we'll be getting our total expense for the year. And then when we less our total expenses, as you can see from the total income we got after adding other incomes, right? Like we always do, the other incomes we have, it was just discount received. When we add that with our gross profit, we get our total income for the year, right? So when we less our total expenses from our total income, we'll be having our net profit, right? A net profit of 44,490 naira. Now this is the net profit value that we're going to be using in the statement of financial position, which we'll be looking at in our next video. All right, so don't forget to like our videos. If you haven't subscribed to this channel, click on the notification button so that when new videos are released, you'll be notified immediately. Leave your comment with us in the comment section if you have any thoughts on this video or any question. We'll see you in our next class. Thank you.